last time, we dug into the story of a business, right? Well, today, we get real with the numbers. We're going to find out if that great story we found is built on a foundation of solid rock, or if it's maybe just sitting on a pile of sand.
So let's start with a little shift in how we think about this. Most people jump into the numbers to try and find the next huge stock market winner. But what if we use them for something way more important first? What if we use them as a shield, a way to avoid the companies that are just destined to fail?
In our last explainer, it was all about the story, the narrative. Today, we're putting that story to the test with cold, hard numbers. This is the reality check. Is that exciting business you found actually built on solid ground, or is it maybe just wishful thinking?
Okay, so here's our game plan for today. We're going to start with why survival always comes first. Then, we'll dive into how to stress test a company's finances, get a handle on debt, and see why cash flow is the ultimate reality check. And finally, we'll cover the big red flags to watch out for, all leading to one single critical question. Can this business actually survive?
So, why this obsession with survival? I mean, shouldn't we be focused on growth? Well, here's the thing. The economy doesn't always go up. Shocker, I know. Recessions happen, crises hit, and when they do, even the best companies can get knocked around. Financial strength, that's what lets a business take a punch and just keep on moving forward.
It really just boils down to this. You can't get returns from a company that goes out of business. It's that simple. Survival has to be the very first hurdle we check. We can worry about how much money we might make after we're confident the company's going to be around in a few years. And this quote just says it all, doesn't it? A business that can't handle a storm will never be there to reward you when the sun finally comes out. All that potential for massive growth means absolutely nothing if the company is just too fragile to last.
So how do we measure this durability? Well, we start with a tool called the balance sheet. And don't worry, we're not going to treat it like some boring accounting report. We're going to use it like an engineering stress test. We're going to see what it can handle.
We're really just using it to answer two key questions. First, does this company have the resources to absorb a hit? And second, does it have the flexibility to pivot and adapt when things, inevitably, go wrong? We can break this down into three really simple steps. First, what the company owns. We call those its assets. Second, what it owes. Those are its liabilities. And most importantly, the difference between them, which is the buffer. You can think of it like a car's suspension. It's that financial shock absorber that smooths out all the bumps in the road.
Now, that whole idea of what a company owes leads us right to our next topic, debt. Now, I know, it's a word that makes a lot of investors really nervous, but our goal here is just to understand it, not to be afraid of it.
See, debt isn't automatically a bad thing. When it's used wisely, it's like rocket fuel for growth. But it has one non-negotiable rule. It must be paid back on time with interest. Debt doesn't care if your sales are down. It doesn't care if there's a recession. That payment is still due.
So the real question isn't, does this company have debt? It's, can the company comfortably handle it? Because too much debt, well, it's like a financial straitjacket. It completely removes your flexibility right when you need it the most.
This brings us to what might be the single most important idea in all of financial analysis. It's the huge difference between what a company says it earned on paper and what it actually has in the bank. Let's talk about cash flow.
This quote just cuts through all the noise. Profits. They can be played with through accounting rules and different assumptions. They are, in a way, an opinion. But the cash sitting in the company's bank account, that is cold, hard reality.
So here's another way to think about it. Profit is an opinion. Cash flow is a fact. A company can report millions and millions in profit, but still go bankrupt because it runs out of actual cash to pay its bills. And believe me, it happens way more often than you'd think.
Because at the end of the day, a business doesn't run on profit reports. It runs on cash. Cash is what pays the salaries, cash is what pays the suppliers, and cash is what pays the interest on all that debt. You run out of cash, and the whole show just grinds to a halt.
Okay, so the good news is you don't need to be some kind of forensic accountant to spot trouble. There are a few pretty simple, clear warning signs you can look for that often point to financial stress.
So be on the lookout for these kinds of things. If a company is constantly borrowing year after year, it might mean the business isn't generating enough cash on its own. If they're frequently diluting shareholders, that means they're basically paying their bills by selling off little pieces of the company. And constantly refinancing old debt, that's kind of like paying off one credit card with another one. It's often a sign of a much deeper problem.
All right, let's pull all of these ideas together now. The balance sheet, the debt, the cash flow, they all point to one fundamental, first step in our analysis.
And let's be crystal clear about our goal right now. We are not trying to predict stock prices. We're not trying to calculate what the business is worth. We're just asking one simple yes or no question. Is this business built to last?
And if that answer is no, well, then the great story, the growth potential, that exciting new product, none of it matters. A weak financial foundation will undermine everything else.
Now you're probably asking, okay, this is great, but how do I actually do this? Where do I find these numbers? Which specific ones should I be looking at? Don't worry. That is exactly what we are covering in our next sessions. We're going to go through it all step by step.
So we'll leave you with this final thought for today. This whole survival-first approach, it might feel a little defensive, but trust me, it is one of the most powerful strategies you can use. Long-term success in investing isn't just about picking the huge winners. It's about making sure you avoid the big losers that can completely wipe you out.
As always, this is just for educational purposes, and it's definitely not investment advice. We really hope this helps you on your journey to becoming a more informed investor. Thanks so much for joining us.